Ryan buys a rental property. Sam puts the same money into index funds. They both walk away convinced they made the smarter choice. They're both wrong because one of them forgot to count the hours and the other forgot to count the zeros. Run the numbers over 20 years and the gap will make your stomach drop. The setup. Let's keep it fair. Ryan and Sam each have $50,000 saved. They both earn $55,000 a year. Same age, same city, same financial starting line. The only thing that differs is what they do with that 50 grand. Ryan puts it down as a 20% down payment on a $250,000 rental property, a modest 3-bedroom in a decent neighborhood. He takes a 30-year mortgage at 7%, making his monthly payment about $1,330. He finds a tenant willing to pay $1,800 a month. On paper, $470 a month in profit before he spends a dollar on anything else. Ryan feels like a genius. Sam takes his $50,000 and drops it into a total stock market index fund. No leverage, no tenants, no keys to hand over. He sets up an automatic $300 monthly contribution and never thinks about it again. When coworkers ask what he's investing in, he says index funds. They nod politely and change the subject. Nobody's impressed. Day one, Ryan has a house, a tenant, and a story for dinner parties. Sam has a brokerage account and a confirmation email. It isn't even close in terms of how it feels, but feelings and math are two very different things. Years 1 to 3, the landlord dream. For the first few years, Ryan is living it. Rent hits his account on the first of every month. He drives past the property on his way to work and thinks, I own that. He's writing off mortgage interest and depreciation, shaving a couple thousand off his tax bill annually. He's building equity with every payment. Comparable homes in the neighborhood keep ticking up. Everything about this investment feels real, tangible, and smart. Sam, he logs into his brokerage account once a quarter. The number goes up a little, then down a little, then up a little more. Year 1, $50,000 becomes about $55,000. Year 2, maybe $61,000.
It doesn't feel like anything is happening. No key in his pocket, no tenant texting him, no asset to point at from his car window. Just a number on a screen. Ryan's friends ask about the property constantly. Nobody asks Sam about anything. The social proof alone makes Ryan feel like he's winning by a mile. Now, let's actually run year 3. Ryan has collected roughly $64,800 in rent. His mortgage payments total about $47,880. That leaves $16,920 in gross cash flow. Sounds fantastic until you subtract everything else. Property taxes, about $3,000 per year. Insurance, about $1,500 per year. Water heater replacement, $1,200. Leaking roof repair, $2,800. 1 month of vacancy between tenants, $1,800 in lost rent, plus $600 to clean and relist. Property management? Ryan handles it himself to save money, which means 10 p.m. phone calls, weekend showings, and coordinating repairs during his lunch break. After all real costs, Ryan's actual 3-year net cash flow lands somewhere around $2,000 to $4,000, not the $16,920 that looked so good on a napkin. And that's before counting a single hour of his time. Sam, meanwhile, has $50,000 plus $10,800 in contributions, growing at roughly 10% a year. His portfolio sits at about $76,000. Hours spent managing it? 0. Phone calls? 0. Emergencies? 0. But Ryan still has leverage working for him. His $250,000 property has appreciated maybe 3 to 4% a year and is now worth around $270,000 to $280,000. House's worth in what he owes has grown to roughly $55,000 to $65,000. That's real wealth, and part of it was built with the bank's money. That's the power of leverage, and it's the one advantage stock investors can't easily replicate. What comes out of the rent check? The rent check is the number everyone talks about. It's the number on the YouTube thumbnail, the number at the real estate meetup, the number your landlord buddy brags about at the barbecue. What nobody talks about is everything that comes out of it first. Vacancy. The average rental sits empty about 1 month per year. Not a disaster, but it's a full mortgage payment with zero income behind it. And every turnover means cleaning, minor repairs, listing fees, and your own hours spent screening and showing. Maintenance and repairs. Budget 1 to 2% of the property's value per year. On a $250,000 house, that's $2,500 to $5,000 annually. Some years it's a $200 faucet. Other years it's a $7,000 HVAC replacement you didn't see coming and can't postpone because it's August and your tenant is threatening to leave. Capital expenditures. Roofs last 20 to 25 years. Furnaces 15 to 20. Water heaters 10 to 12. These aren't risks, they're guaranteed future costs, and they arrive in chunks of $5,000 to $15,000. If you're not setting money aside monthly for them, you're not running a business, you're running on luck. Property management. Hire someone, and that's 8 to 10% of monthly rent gone instantly, roughly $150 to $180 a month. Manage it yourself, and you're working a part-time job nobody pays you for. Either way, it costs something. And the risk nobody likes to discuss, bad tenants. A tenant who stops paying and understands the eviction process can cost you 3 to 6 months of lost rent, plus legal fees. That single event can wipe out an entire year of profit, or more. None of this shows up in the $470 a month number, but it shows up eventually. Year 5, reality sets in. Ryan is on his third tenant. He's replaced the roof for $8,500, handled a plumbing emergency for $1,400, and eaten another month of vacancy. He's raised rent to $1,950, which helps, but property taxes and insurance have climbed too. His actual cash-on-cash return, money pocketed relative to money invested, is hovering around 3 to 5% after real expenses. Not bad, but nowhere near the 15 to 20% he told his friends about at the barbecue. Sam is still doing absolutely nothing. By year 7, his portfolio has grown to roughly $135,000 to $150,000, contributed included. He didn't pick stocks.
He didn't time the market. He didn't do anything except not touch it. And the compounding is starting to accelerate. The gains on his gains now generate more new wealth each year than his own contributions do. Here's what's happening underneath. Ryan's wealth is growing, but slowly after expenses, and it demands constant attention. Sam's wealth is growing along a curve, slow at first, then faster and faster. Compounding is boring for the first 5 years and astonishing for the next 15. Year 10, closer than you think. Ryan, property worth roughly $335,000 to $350,000. Remaining mortgage balance about $166,000. Equity approximately $170,000 to $184,000. After subtracting every real cost, interest, taxes, insurance, repairs, vacancy, capital expenditures, his total out-of-pocket beyond the original down payment sits somewhere between $20,000 and $35,000. Sam, portfolio at approximately $165,000 to $180,000. He's put in $50,000 up front, plus $36,000 in contributions, $86,000 total. Everything above that is pure compound growth. Weekends spent fixing things, zero. At the decade mark, they're surprisingly close, and Ryan may be slightly ahead thanks to leverage. But consider what else Ryan did. Hundreds of hours managing the property, hundreds of thousands in debt, and his entire investment concentrated in one asset in one zip code. Sam is diversified across thousands of companies and hasn't lost a night of sleep. Year 20, the full separation. Ryan, property worth roughly $450,000 to $500,000. Mortgage paid off or nearly so. Equity somewhere between $400,000 and $500,000, depending on appreciation. He's collected rent the whole time, but after 20 years of maintenance, repairs, turnover, taxes, insurance, and at least one major renovation, his total net profit from cash flow is maybe $40,000 to $80,000 above what he spent. More in a hot market, less in a flat one.
Sam, at 10% average annual returns with $300 monthly contributions, his original $50,000 has grown to approximately $420,000 to $460,000. Total contributions over 20 years, $122,000. The other $300,000 plus is pure compounding. No debt, no tenants, no 2 a.m. calls about a burst pipe. On net worth, they're in the same ballpark, roughly $400,000 to $500,000 each. But how they got there couldn't be more different. Ryan worked for his. Sam waited for his. Ryan carried stress, concentration risk, and illiquidity. Sam carried volatility, but kept liquidity and freedom. And here's the detail that shifts the math dramatically. If Sam had raised his contribution by just $200 a month to $500, his 20-year portfolio jumps to roughly $550,000 to $600,000. That's the asymmetry. In the stock market, increasing your contribution multiplies through compounding. In real estate, increasing your investment usually means buying another property, taking on another mortgage, and doubling your workload. The honest case for real estate. If I only showed you real estate's downsides, I'd be doing exactly what every stock market influencer does. So let's be fair. Stocks carry real risks people love to gloss over. Volatility is brutal. In 2008, the market fell roughly 37%. In March 2020, it dropped 34% in a single month. If Sam watched $150,000 fall to $95,000 in a few weeks, that's not a number on a screen. That's gut-wrenching. And the data is clear. Most retail investors panic sell during crashes and buy back after the recovery, locking in losses at the worst possible moment. There's no cash flow. Index funds don't mail you a monthly check. Dividends exist, but a total market fund yields maybe 1.5%. On $150,000, that's about $200 a month. That's not replacing anyone's income. There's no leverage. Sam used $50,000 to control $50,000 in assets. Ryan used $50,000 to control $250,000. That 5-to-1 leverage is enormously powerful when property values rise, and it's the main reason real estate creates more millionaires than the stock market in many surveys. And there's no tax magic like depreciation. Real estate investors can deduct the theoretical decline in their building's value from taxable income, even while the property is appreciating. That's a legal tax shelter stock investors simply don't have.
Where real estate genuinely wins. Strong rent-to-price ratios. If monthly rent is at least 0.8 to 1% of purchase price, the cash flow math works in your favor from day one. Treating it as a business, not a side hustle. Screen tenants carefully, budget for capital expenditures, build systems, and returns can beat stocks, especially with leverage. House hacking. Live in one unit, rent the others, and cut your own housing costs to near zero while building equity. The stock market can't do that. 1031 exchanges. Defer capital gains taxes by rolling profits into a new property and grow your portfolio in a tax-advantaged way stock investors can't replicate outside retirement accounts. Real estate isn't a bad investment, it's a misunderstood one. The actual lesson. Ryan and Sam both walked away from that decision certain they'd made the smart play. Ryan believed real estate was the proven path to wealth. Sam believed the stock market would do the work for him. Neither of them ever sat down and mapped out what their choice actually cost in dollars, in time, in stress, and in risk. Over 10 or 20 years, the real trap isn't real estate and it isn't stocks. The real trap is picking either one based on a YouTube headline, a podcast clip, or something your uncle said at Thanksgiving, without ever running the full numbers for your own situation. And if you're wondering what happens when you do both, own property and invest in the market simultaneously, that's a completely different conversation, and the math might change everything you think you know. For now, the next time someone tells you real estate always wins or the stock market always wins, ask them one question. Did you include everything?
because the answer that includes everything is the only answer that matters.